Hi, I'm Steve Forbes, and you're watching Traders Nation.
Welcome back. You are tuned in to Traders Nation. My pleasure to have back with us once again Anthony Saccaro, President of Providence Financial. Anthony, welcome back to Traders Nation. How are you today?
I'm doing phenomenal. Thanks, Kurt.
Sure. Hey, listen, consumer confidence in April, all right, rebounds close to an 18-year high, Anthony. What does this mean for America?
You know, the 18-year high is great. I mean, it sounds good, but in some ways, I almost feel like we might be back at 2007 all over again. You have to remember, back then, everything was great as well. Stock market was at peak highs. Sure. Real estate was at record highs. And then we bottomed out in 2009. We were down. The market was down over 60%, and now we're up almost 400% in the last decade. Yeah. And we know that no good party lasts forever. So I'm actually concerned.
Are you? Okay. So back then certainly it was housing, a default of loans, things of that nature kind of hit that. Some people don't realize this, but it's actually the price per barrel of oil that actually kind of kicked that off, and then the housing crisis hit, and then everything fell apart. What would you think would be the catalyst this time around with all the euphoria?
Well, I think there's a couple of potential catalysts out there.
Yeah.
I think the biggest catalyst is probably the fact that we've gone into more debt as a country in the last decade than we had in the entire previous history of this country. I mean, we're kissing like $21 trillion in debt. And, you know, the Federal Reserve is supposed to be able to raise interest rates when the economy is overheated. That's kind of like putting the brakes on the economy.
Yeah.
And yet they haven't been able to do that. So interest rates have not rebounded. And I think where the rubber meets the road is with interest rates. I think that's more telling than almost anything out there. But the debt could be that catalyst.
All right, so interest rates hitting the road is going to be the tall tale of the tape from what I'm hearing. Well, you know, let's go back to confidence in real quick, because then we can lead up to potentially what's going on. So confidence is coming in several areas, and people feel that prosperity, better pay. Even if they're not getting it, they feel a sense that there's going to be a better pay for them. Jobs, certainly, job numbers are great, 3.9%. So the confidence is kind of fueling all the euphoria. Would you agree with that?
Well, it absolutely is, and it's one of those things that when you're sitting in a bar next to someone who tells you what stock you should be buying next,
right?
You and I both know that that's the time to start getting out of the stock market, when you start getting tips from grandma and other people that don't really know what's going on.
Yeah.
And that's the way it was back in 2007, and it's almost like 2017 fueled consumer sentiment. The stock market went up 25%. Now there's people that you feel like they're getting missed out on, or they missed out on that, and now they're getting back in. I think it's the worst thing they can do at this point.
So they're chasing it, right? They feel like they missed out, so now they're chasing, which is you never do that. You never chase a stock, let alone the market. Interesting. Okay, so Americans are feeling much better about their financial future, and certainly we're talking about that here today. Are we seeing any signs of, you know, people are spending money, but are we seeing any signs of people actually saving money or maybe even playing catch-up to the last 10 years?
You know, that's the one good thing that's happened over the last 10 years is 2008, that whole time period, really woke people up and got people to realize that the market doesn't just go up forever. And yet I'm worried that people are starting to forget that. But really, debt has come down quite a bit. Savings has gone up quite a bit in the last decade, and that's a very positive sign in general.
Sure. All right, so people spent a lot of them. Well, listen, they had to bail themselves out, first of all. They lost a lot of their money, so it certainly makes sense to me that that sting of the market dropping, maybe a lot of people learn from that, but I'm hoping that they don't forget that, because that certainly is a big issue, and we certainly have short memory spans, don't we? All right.
You know what? That's exactly right. You know, and the fact is, the last 10 years the market's done well.
Yeah.
People have forgotten that in the last generation, 18 years, we had a 50% correction or crash in '01. We had a 60% correction or crash in '08.
Yeah.
And now we've just rebounded from that. The stock market over the last generation has produced less than 4% a year return if you buy and hold like they want you to.
Right. All right, so as a financial planner, let's talk about advice that you can give people here today looking to recover from the last 10 years. What would be a plan, Anthony, that you would lay out for folks, or have been laying out for folks, I should say, when they're trying to recover, whether they have a little bit of income to help them do that or a lot? What's your plans that you're laying out?
Yeah, so I think there's really two categories of people. First are the younger people that I think should be in the stock market. And the plan we're laying out for them is to hold off of the stock market for now, tread water, put your money in a safe place that's going to earn 4 or 5%, wait for a better buying opportunity, which is almost certain to come. And then for our older people, a lot of our clients can live off of 4 or 5% a year interest. Why gamble at all? Why put your nest egg at risk at all? Take your 4 or 5%, live off that, never have to worry about selling shares to get your income, and don't go back to the Wall Street casino. You don't need to do it.
That's right, the Wall Street casino. Fixed income, good for older folks. So let's say that I'm 25, 30 years old, maybe even 40 or 50, let's say, right? So I'm working, and certainly companies have their 401ks and bonuses. Would taking those bonuses to me is like lost or found money, right? It's not part of your monthly bills. It's not part of your monthly income where you're going to have to pay out bills. What about taking found money like that and putting it away? Would that be one good way to start saving or to continue your saving on top of everything else you're doing?
Oh, absolutely. If you've got a retirement plan and you're fortunate enough to have one of those plans that still matches, you got to put in there at least what you need to put in order to get the free match. Outside of that, if you have debt, I think the best thing to do at this point is take some of those savings. Once you've built an emergency fund, take some of those savings and pay off your debt, because paying off debt is saving. And a lot of people don't get that. So you want to build the emergency fund, pay off your debt, and then start saving outside of that.
Yeah, because that's a great point that you're making. You know, being debt-free gives you better staying power as an individual, or even as a business for that matter. And also, being debt-free or working your way there is financial independence. So you don't have to have a lot of money in the bank, which certainly that's the ultimate goal. But at least at this point in someone's life, if you're debt-free or almost debt-free, isn't that financial freedom in itself, Anthony?
Oh, absolutely. That's huge, being debt-free or being able to be debt-free, having strategic debt that you could pay off if you need to. That is financial freedom. And really, it's all about cash flow and having more income coming in than you have going out. And so the bottom line is you got to control your cash flow. And if you control your cash flow and you make sure that you've got more coming in than going out, then you'll be okay.
I think so. All right, so I'm going to pop over to something really quick before we run out of time. I want to talk about signs of inflation that they're popping up. Cost of raw goods, energy to produce, etc. Do you think that this type of inflation of growing costs to do business or buy goods, raw goods, things like that, you think that's going to shake up a little bit of the confidence that we're seeing in the market, or you think we're going to be able to chew through that? You think confidence will be able to chew through some of those costs?
Well, as inflation grows, then the Federal Reserve is supposed to raise interest rates. I mean, those two go hand in hand. Yeah. And the Federal Reserve can't raise interest rates because of the fact that we're $20 trillion in debt. And for every quarter point that they raise interest rates, the government is going to have to pay an extra $50 billion a year in interest. So there's very conflicting information. I think that inflation is going to stay low for a long time for one reason, because the baby boomers are older at this point. Yeah. And when you get older, you tend to spend less money. And if you spend less money, that there's a less of a demand for goods and services. And so the demand, I think we're in a lower inflation environment. Okay. And I think it's got potential to be here for a long time. Okay, so all those raw goods, cost of raw goods and energy to produce those raw goods, those are going to be fluctuating within the cycles of a given year, right? So what is basically what all that we're going to be looking at here. Well, that's right. So, I mean, everything's going to fluctuate as well. Yeah. As the boomers get older, it's going to keep inflation down. And let's not forget about the fact that the dollar's been on the rise as well. Yeah. Certainly depends when you talk, but a strong dollar's bad for exports, right? Yeah. And that also is bad for the producers. Okay. And so that's going to hurt us with inflation as well, too. Anthony. So inflation numbers look good, but I don't think they tell the whole story. Where can we find you at? ProvidenceFinancialInc.com. ProvidenceFinancialInc.com. Anthony Saccaro, thanks for being with us today. Kurt, thank you for having me. Have a great day. We'll be right back.